Good morning, everybody. This is the Live Market Open for Friday, November 27th. I'm Yohay on Forex.com, Market Movers podcast, doing the show as usual for FX Street. It's the day after Thanksgiving in the United States. We have a few recent developments, some charts and levels, and next 24 hours. This time it's going to be more about next week. Okay, we're gonna, of course, have questions and answers as always. And if you don't see the chat box under the video, please go to tlk.io/fxstreet-forex-live-video. Okay, so let's begin. Yesterday we had, these are the FX Street, these are the ECB rumors that we had beforehand. And since then, we didn't have any news regarding that. I'll just mention them once again. They're talking about a two-tiered negative deposit rate and about perhaps buying municipal bonds. They didn't give us any numbers, but the rumor mill is working very fast. So we have that in mind, and that's, of course, towards next week's big event, okay? The big ECB event. Okay, so we have that. What we had overnight is that we had Japanese inflation numbers coming out more or less okay. So let's take a look at them before we continue. So we have the figures here. Let's see why they're not refreshed. Anyway, let's look at dollar yen. In the meantime, dollar yen is trading in a very clear range. There's clear support at 122.20. We're a bit closer to this level. Okay, the figures in Japan. Let's see if we have them here. Yeah, this is the full week. This is the FX Street calendar on Forex Crunch. Can't seem to. Oh, all right. Here we go. Lots of inflation figures from Japan. Too much information, you may say. Anyway, the core figures from Tokyo, which is the month for the month of November, it came out at 0% year over year, which was better than expected at minus 0.1. So that's good news, right? Because, of course, it came out better than expected, but it isn't that exciting. If you exclude food and energy, another sort of measure of this inflation, we have 0.6%, which is a bit, which actually is a bit better than, I don't know why it's negative here. Anyway, it's better than expected, still far from the 2% target. Okay. The general consumer price index is expected 0.2, excluding the fresh food. The national figures are for October, Tokyo is for November, so more or less as expected. Unemployment rate in Japan, with all the problems that the economy isn't really growing, the unemployment rate is one to envy, 3.1%. And but on the other hand, household spending disappointed with minus 2.4% drop year over year. So Japanese, it's like retail sales, they aren't spending enough. As expected, okay. So these are the figures we had from Japan. All in all, we're seeing dollar yen fall, but I think it's much more related to some weakness, some sell-off in the US dollar, because we see the same phenomenon also in euro dollar, which is, within the range. It's a bit higher. Yesterday we had comatose trading action, no movement at all, especially in the US session, because it was Thanksgiving Day and we didn't have news from any place in the world. Okay. What else do we have overnight? Import prices from Germany disappointed. They fell year over year 4.1%. It isn't a surprise, of course, because a lot of what's imported is energy, oil, and oil prices fell, as we know, throughout the past year or so. These base effects will level out soon, because the biggest fall in oil prices came out in November last year. Okay, so we'll soon see it fade away. These are figures for October. We had French producer prices, not that interesting, but consumer spending also disappointed, fell by 0.7%, worse than minus 0.1. And from here in Spain, we had a better than expected figure. The CPI dropped by 0.4% year over year. That's better than expected, and it's a fresh figure for the month of November. Okay, so it's of importance. On Monday, we have a German CPI, which is more important and feeds into the all-European CPI, and that feeds into the ECB decision. So that's what we had so far. Yeah. Today we have the second estimate of GDP for the UK. It's 1 hour 25 minutes. That's right. And let's see what we're expecting there, and let's see the pound afterwards. So we're expecting it to remain unchanged at 0.5%. This is the key figure, the quarter-over-quarter number for the UK is important, and it's not annualized like in the United States. So it's the equivalent of around 2% growth in the United States, very similar. This is the quarter-over-quarter, not annualized figure. We also have the year-over-year figure, which is not annualized. It's a different measure. Anyway, also expected to remain unchanged. And we have some secondary figures like total business investment and things like that. From my experience, usually in the United Kingdom, we don't have bigger visions. Okay, we have it ticking 0.1 higher or lower, nothing really big. Anyway, pound dollar cable is within this range of 150.60 to 151.15, rising just a bit because of some early morning US dollar sell-off. Nothing to get too excited about. We have clear ranges. The range is quite low. I think that the GDP figures will remind us that the economy in the UK is actually doing pretty well, and that the dovishness of the Bank of England is not really justified. Okay, so that's the main event we have today. And at 12, we also have German consumer climate, the GfK figure. The GfK, yeah. It's right here. Sorry, that's already 4. Yeah, it's here, GfK consumer. It's expected to slide from 9.4 to 9.2. Consumers were in general a bit more optimistic throughout the year, but at some point they lost this optimism and this consumer confidence fell a bit down. Okay, so this is a second-year figure. I don't expect it to move markets that much. Okay, so today is in general a quite light day. Okay, we have figures from India, figures from Ireland, but nothing, the main market. For those of you trading the Canadian dollar, we have some figures from there. We have the industrial product price index and the raw material price index, but these are also second-tier figures, especially when we're looking to next week. We have a question here from Shapil. GBP, no matter if news good or bad news for GBP means pound goes down 90%. Still don't know why. Well, one reason for the pound falling is that we have had some dovishness from the Bank of England. We had them worried about inflation. Okay, we had them saying that inflation is too low, and even the wage rise, which is quite evident, quite clear, quite strong in the United Kingdom, it just isn't good enough. It's going to slow down. Now, it's 3% year over year, better than the United States, and it points to real inflation in the future, not inflation that is related to oil prices or things like that. So I believe they're a bit too dovish, okay, in the Bank of England, but we'll have to wait and see about that. Okay, let's take a look at a few more currencies here on the chart. Basically, movements were relatively slow. Dollar CAD dropped to support here at 132.80, which I mentioned in the past. Resistance at 133.70, but now it's climbing a bit back up, very, very moderately, very gradually. This week we had some developments regarding oil, coming both from Saudi Arabia. First of all, Saudi Arabia said that they want to cooperate with other countries, OPEC and non-OPEC members, regarding the prices. And then yesterday, I think we had an article from the Financial Times saying that in private conversations, the Saudis want an oil price of $60 to $80 a barrel. Why are the Saudis waking up? It's basically, oil prices are, still depressed. They went into a high range between 42.70 to 43.40, but now they're dropping once again into this range. Support awaits at 40. Talking about oil because of the Canadian dollar and because we have OPEC meetings next week. It's one of the events. It's on Friday. But it's not only the event itself, it's also the preparations. Okay, so we have what I'm talking about, oil. What I want to say about Saudi Arabia is that a year ago, they had a different policy. Their policy was, let's control our market share. Let's pump out oil, produce as much as possible, continue selling it at whatever price to maintain the market share, to keep on selling high quantities, and let the others suffer from lower oil prices. This includes its fellow OPEC members such as Venezuela and quite a few other countries, non-OPEC members like Russia, or of course Islamic State, which is extracting oil out of Syria and Iraq and selling it via Turkey and other areas. So they wanted to hit their market, they wanted to maintain their market share, and they also wanted to hurt the US shale industry. Okay, a year afterwards, they did maintain their market share, but the hit in prices is beginning to hurt the Saudis. Okay, because you have an authoritarian regime, harsher, I would say, than Iran, and they want to make people happy, forget about lack of human rights. So they need to splash the cash. And when they have less cash in their coffers, they have to perhaps make some changes and rethink some stuff. Okay, so now they're beginning to maybe change course, but we're not seeing it yet in oil prices. Okay. So this is the chart of oil. Let's continue to the Australian dollar. Australian dollar had a nice ride this week, went up to resistance. Very nice technical behavior for Aussie dollar. Went all the way to resistance at 72.80, and now it's falling back down. The reasons for rise in the Aussie were the fact that the RBA is not worried about the exchange rate, and that the RBA, the Reserve Bank of Australia, is also they would like to support growth by cutting rates, but they're not sure it'll work. Okay, so one of the big events we have next week is Tuesday morning, the RBA decision, and they're not expected to change policy over there. Okay, and it's the last meeting until February because they're on summer vacation in January. So that supported the Australian dollar. On the other hand, not all is good in Australia. We had this week the capital expenditure report, and that came out with a big drop of 9.2%, and that hit the Aussie dollar. Okay, so we're seeing it back to range. I marked 72.20, some kind of pivotal line, really strong support at 71, or more serious support at 71.50, and then 70.65. Okay, resistance remains at 72.80. Kiwi dollar, very range bound. Time to adapt a few technical levels here. So I would say that we have, this is more of a correct range at the moment. 65.50, sort of this pivotal line or currently support line in the middle of the range. Range is 65 to 66.40. Okay, all in all, range bound. And also New Zealand, some things are good, like prices in Auckland, unemployment, both things are looking good. On the other hand, the milk prices fell, so that's what we had also in New Zealand. And dollar Swiss, well, with the weakening of the euro this week to new lows of 105.66. Also, dollar Swiss went up. Why? Because the Swiss National Bank is very mindful, let's put it this way, or in a more blunt way, intervenes to maintain the weakness of the Swiss franc against the euro. So this means that if you look at dollar Swiss, you look at an inverse, more or less inverse of euro dollar. We reached new highs above 102.50. Now we're back to range 102.33. Okay, but it's not a pair I like too much. Here we have euro Swiss. You see it's being a bit pushed up, perhaps by the Swiss National Bank. 108.72. Ranges here are very, very narrow. We're off the lows of 107.60 and high resistance, I would say, at 110, 109, but not. We're moving very slowly there. Euro pound at 70.40. We had this range trading, now we're a bit higher, and that was because of the collapse of the euro. but also the pound has its own issues with the Bank of England, which is worried about inflation, despite actually this week we had core inflation, or last week, sorry, had inflation, core inflation going up, and wages are still looking good in the UK. There are reasons to worry about the future because the Eurozone is weak, and the weak Eurozone means weakness in the UK because the continent is a major trade partner of the UK. Okay, Euro Yen continuing its downtrend, mostly because of the weakness in the euro and the stability of the yen. So it's still battling 130. 128.75 is further support resistance, and 130.62, which was a swing low back in mid-November. Okay, and pound yen, one of your favorites. Well, it dropped all the way and found here this double bottom support at 184.60. Now it's sliding once again towards this line. Sorry, the line is 184.30 and currently at 184.60. Resistance at the round number of 186. Further resistance 188.10, which was a high line in September. Further support at 183.80 and then 183. Okay. So these are sort of the main charts I'm watching. More questions I see before we move to the next topics. Yeah, thanks to ISIS selling cheap oil almost free. You're long. Yeah, ISIS is. Yeah, they produce oil from oil fields in Syria and Iraq and sell it through smugglers. That's a whole topic. You're long pound dollar, and you put on a nice chart, I see. So thanks for putting the chart. Maybe you'll put it here on the screen for everybody. Yeah, right here. Okay. So you go long. Yeah, and the fundamental. So thank you, Shabil. Hope I'm pronouncing that correctly. Anyway, thank you for sharing the chart. I welcome everybody to share charts. Yeah, the fundamental reason for going long, my main fundamental reason, is that in the United Kingdom, they're about to raise rates just like in the United States, and specifically, of course, afterwards, and that the recent sell-off has been exaggerated. These GDP numbers could provide us some fuel for a recovery. So I hope everybody can see the chart either in the chat box or now in the video. Let me sort of enlarge the screen just a bit. Thank you for sharing, and welcome other people to share as well. Okay, so that's a nice trend line. I see here higher lows, and that I guess is one of the reasons you're going long, and the target is 152. Okay, thank you. To continue to other stuff, we talked about main charts, and we talked about what we had so far in markets. Let's do a small recap of what we had so far. This week in markets, we had, well, until Thanksgiving, it was quite busy. Tuesday and Wednesday especially. We had, let's filter out here the main events. It'll also provide those of you who are unfamiliar to see how to use the FX Street calendar. Let's take these events. Let's filter out only the important countries. Well, sorry if I offend anybody, but the ones that we focus on as currency traders would be a better way to put it. Anyway, we had quite a few events in markets, especially in the United States on Wednesday and on Tuesday. Right here. So let's begin from the top. We had PMIs early in the week on Monday, and they came out better than expected. Most importantly, they came out better than expected for Germany, the biggest country in the Eurozone. Okay, so this was positive news. It helped the euro just a bit. Okay, we had a revision of GDP in Germany. Nothing changed there. The second good figure we had from Germany came on Tuesday with the IFO figure. all the figures, the current assessment, the business climate, and the expectations came out better than expected. Okay, so this was good news. In the United States on Monday, I skipped this, we had, well, existing home sales, they came out within expectations. What we had on Tuesday morning from Australia, a rare hour for Australian events, but this was a speech. We had the governor of the RBA, Glenn Stevens, talking about that he would love to help the economy by cutting rates, but he's not sure it'll happen. It'll help, and that strengthened the Australian dollar. And then we had Mark Carney, the Canadian in charge of the Bank of England, speaking in front of Parliament, in front of a committee of Parliament in Westminster, and basically sharing some dovish thoughts in the inflation report hearings, and that weighed on the pound. Then we had an upwards revision of GDP in the United States. That was good news, but more or less as expected, 2.1%. Basically, this keeps the Fed on track to raise rates. Other figures that we had was a mediocre CPI, the core personal consumption expenditure was, oh, that's a quarterly, sorry, it's not the important one I'm looking at. So this was good news for the past, but for the present, for Black Friday, for Thanksgiving, the consumer confidence from the conference board fell short, okay, fell 90.4 points. We had then quite a few figures on Wednesday, just before Thanksgiving. They were crammed in. So the good news was the durable goods orders came out better than expected. Okay, 3% here. The headline figure, core figure also a bit better than expected. Excellent news, because this means investment. This means the future is a bit brighter. The bad news came from the core PCE price index, which remained unchanged at 1.3%. That means that inflation, core inflation, the most important figure for the Fed when talking about inflation, is still a bit stuck, okay? And jobless claims, well, they came out better than expected, 260,000. Good news for the job figures next week. And then we had, once again, a mediocre figure for the housing. It came out, well, okay figure, just below expectations for new home sales. And the other consumer sentiment figure, the University of Michigan, came out revised down. So both consumer sentiment figures point lower, okay? Both point to less Black Friday shopping, but who knows? The correlation between these surveys of consumers and actual spending are sometimes quite weak, okay? Yesterday was quite a boring day. Not much happened, but today we had the inflation figures from Japan, and of course, UK GDP is the main event, okay? But what I want to talk about is, sorry for that noise. Anyway, what I want to talk about is next week. So let's get ready for next week. But also I would like to have your questions. And let's look, before I move to talking about more fundamentals, let's take a look again at euro dollar. I haven't talked about the levels here. So we have 106.16 at the moment, low range. The range is between 105.66, which was the swing low earlier this week, and 106.30, which was support back here earlier in the month, earlier in November. Further resistance at 106.17, week one, 107.10, and stronger, really much stronger resistance at only at 108.30. Further support, if we move to the daily chart, we can see 105.30 back here, the low in April, and 104.60, which is really critical support. It's a 12-year low for euro dollar. If we zoom even further out, we can see that the last time these levels were seen were back here in 2003. Okay. Anyway, we've seen already lower lows in euro dollar, okay, below parity. But that was way, way back in the past. Okay. Anyway, just to look at history, let's go back to the present. We're right here. Question from Fabian. Good morning. Can you explain the relation you mentioned before between the bad German data and oil prices? I didn't mention bad German data with oil. Yeah, import prices. Sorry. Yeah, sure. The bad German data was the data related to import prices. Now, in Europe, there's little production of energy in general, and lots of things are important, including oil from Libya and from all over the world, gas from Russia and from other places. And these commodities, especially energy, which are essential to heat up German homes and homes also. I use here gas for heating in Barcelona, so these are imported. And the prices of German imports fell 4% year over year, and that's mostly due to oil prices. Now, the big question for the ECB meeting next week, December 3rd, Thursday, is what we've heard from Draghi. Is the fall in oil prices, which can be dismissed in the United States, it's dismissed. They say it's transitional, it's not important. Okay, we have to look beyond that, through that. In Europe, what we heard from Draghi in the recent press conference on October 22nd is that there's a fear that this fall in prices from energy, from commodity prices, from more volatile items, will feed into core inflation, will set a deflationary mindset. What is a deflationary mindset? It means that I, as a consumer, I believe that prices will fall. This week is a good example. Okay, also here in Barcelona, we have Black Friday. So if I wanted to buy something early in the week, I decided, okay, let's wait because maybe they'll give me a discount on Black Friday. Okay, so that's temporary deflationary mindset. But if everybody thinks that all the time, no, prices are falling. Let's wait another month. Let's wait another year. Let's wait until prices fall. We have less economic activity, less sales. Factories produce less. The factory lays off workers. These ex-workers have less money in their pockets to buy. So this is something that the ECB fears, and that's why it's acting to try to lift inflation. That's what happened in the Great Recession in the United States. Okay, let's talk a bit more about the ECB before we do a full preview of next week. So the European Central Bank told us on October 22nd the following things. Let's look at I have this on the slide. It told us, first of all, that it's ready to act, okay? In December. When they said ready to act, too many slides I have here. Right here, okay. Ready to act in December by opening the door to extending QE beyond September 2016. That's the easiest thing to do. It's just talk, okay? They said they'll have the program until December 2016 and September 2016, and they can extend it beyond, okay? Because we're only in December. We're going to be in December next week. So it's, they can always change their policy over and over again regarding the future. Okay, that's the easy part. The bigger issue is opening the door to expanding QE beyond 60 billion a month. Okay, in January, they began the APP program, it's called here in Europe, Asset Purchase Program, or QE elsewhere in the world, quantitative easing. And they want to expand it beyond beyond 60 billion. They began it with 60 billion. According to a poll by Reuters published this week, they think of extending it economists think that the ECB will expand it beyond 60 billion to 75 billion. That's significant expansion, 25%, but it would need more. It has some political hurdles because the Germans don't really like all this money printing. What we had, the bigger surprise back in October, was that the ECB was ready to open the door to cutting the deposit rate. It's currently minus 0.20. Banks are punished for holding money with the ECB, and they might cut it below these levels. Why? That will also encourage banks to lend money to the real economy, get people spending, and also, of course, weaken the euro and thus make European exports more attractive and make imported prices also more expensive, and that altogether could lift inflation. The ECB has an inflation target of 2% or a bit below. Currently, headline inflation, the ECB's target is around 0.1. and core inflation is only 1.1. So it's not a bit below, it's well below. And what we heard recently from Draghi is that the strengthening in core inflation is just not good enough. Okay, so it's beginning to slow down. So the ECB wants to answer your question, Fabian, to address wants higher inflation to battle this deflationary mindset. And if prices begin rising, people will think, okay, they'll rise, so I better buy now. That could, of course, create an inflationary spiral, because if everybody thinks that way, the prices will go up, they begin buying, and then prices go up, and then it creates this cycle. Anyway, what we heard this week regarding the deposit rate is, first of all, that economists think that it'll be cut only from 0.20 to 0.30. And I believe it's wrong, because the experience from Switzerland and Denmark shows us that it can be much lower, and 0.50, 0.75. And another thing we heard from the ECB, also from Reuters, is that they're considering a two-tier system, punishing less the retail banks, those that we normal people work with, and punishing more the wholesale banks, the ones that do business, so that those banks will lend more money to the real economy. And if we deposit money in the banks, we won't be punished so much. Okay, so that's what we have from the ECB. We also heard back in the past worried about inflation. We talked about that. Worried about the exchange rate, and the biggest hint that we'll have action came from the word vigilance, just a word in the dictionary, but the predecessor of Draghi, Jean-Claude Trichet, used to use this word in order to hint that we're going to have action next month. In this case, the action meant that we're going to have a rate hike. That was back in 2011. Now we're in a situation where this vigilance means action in the next month. Okay, and this means cutting. Now, what's important for me to stress out regarding the ECB preview is what we had in January. I think I mentioned this on the show a few times, but we had Draghi managed to create expectations which were relatively low and then exceed them. They were talking about 40 to 50 billion per month QE, and then what happened was 60 billion. We had the total package between 500 and 750 billion, and eventually it came out at 1.1 trillion, and now it can be expanded beyond. Okay, so I believe that this time as well, they're creating some expectations and they want to beat them. Why beat them? To push down the value of the euro, and also to move the mindset and show people the ECB is ready to act, to boost the economy, to boost investor confidence, and all these things. Okay, so yeah, I have another question regarding that. I know that with the Fed member banks, every night have to deposit 10% with the Fed. It's the same with the ECB. It's member banks in Europe. I'm not aware of the exact details, but if the banks have spare cash, they park it with the ECB. The idea of this negative deposit rate, the idea of ECB buying bonds, is to free money for banks to lend it to the real economy. That's a transmission mechanism. So far, the transmission mechanism has worked the best with just weakening the exchange rate. Now, let me address one concern that the value of the euro fell a lot in recent weeks. Okay, we were around 114, 113. Now we're around 106. Okay, and the Fed. One of the reasons is the ECB hints about action, but also the Fed is ready to act. So why shouldn't the ECB just continue talking and talking, and let the Fed act? Let the Fed weaken the euro, strengthen the dollar against the euro, and then the ECB can think once again in its January meeting what to do. Now, my answer to that is what you mentioned here, the word vigilance. If they backtrack, if they don't act now after giving us all these hints, it'll be backtracking. It'll hurt the credibility of the ECB and can push the euro back up. And so maybe they won't do everything possible, but they'll do a lot. And from my experience, in January, from our experience in January, they are expected to hit the euro quite hard. Okay, so that's the ECB preview. I believe that for euro dollar there is a greater danger from the ECB than from the Fed. Fed is coming on December 16th, but we do have quite a few events. Looking back at the calendar right now, let's well, you have any more questions, or we'll begin? Want to do a full? Last week we did a preview for the first time of next week's events, and published it separately, and it gained a lot of views. A lot of you were interested in this, so we'll do again this kind of preview. But beforehand, before we reach the preview, and perhaps something else. Here are the figures I was talking about. The ECB expectations are for minus 0.30 and QE to rise to 75 billion. There's another question regarding the ECB I didn't mention before, is the lending rate, not the deposit rate, the fee, the interest rate that banks pay to take money from the ECB to borrow. It stands at 0.05. All economists expect it to remain unchanged. What are the most market-moving events next week? Sure, we'll cover that. Before that, maybe other questions about other things. I think we'll begin with the regular wrap-up, and then perhaps we're seeing the US dollar strengthen once again during the show. So before talking about next week, we'll do the regular wrap-up. Perhaps beforehand, more questions. No, let's begin the wrap-up early, and then do a full preview of next week, which is very busy. So this is the wrap-up for the live market open of November 27th. It's Friday after Thanksgiving. We didn't have a lot of developments yesterday in markets. We had Japanese inflation coming out okay, still mediocre. German import prices disappointing year over year and month over month, weighing on expectations in general, but second-year figure. And Spanish flash CPI took a better course, came out better than expected. All in all, very quiet markets yesterday. Today is a bit more busy, and we have the big event of the day is the revision of UK GDP at 9:30. It's expected to remain unchanged at 0.5%. Another figure to watch is German consumer climate at 12 GMT. Both are not expected to rock the boat too much unless we have a big surprise in the UK. And in some figures for Canada at 1:30 GMT. All in all, we might have some action today, not because of these events, but because of some end-of-month fixings. Okay, we might have some last-minute adjustments. It's not the end of the month. We have another full day on Monday, but it's still Friday. It's the end of the week, so we might see some unusual activity. I don't think it'll be really, really extreme. Okay, so UK GDP is the main event for today. Let's talk about some charts. Euro dollar in range 105.66 to 106.30. Currently at 106.13. We've seen a small rise, but back down well within the range. Pound dollar. It was hit hard by Mark Carney this week for the second time, but still within range. 150.60 to 151.15. Dollar yen getting closer to support at 122.20. Double bottom here on the charts. Resistance at 122.75. Bigger lines to watch: 122 to the downside, close to 122.20, and 123.60 to the upside. Dollar CAD enjoyed some improvement in oil prices. Currently at 133.20. Support 132.80. Resistance 132.70. Eyes are on the OPEC meeting next week. Oil prices have stabilized, but haven't really risen. The Aussie dollar was hit hard this week by private expenditure, but supported by the RBA. Lines to watch 72.80 and 71.50. All in all, relatively stable. Kiwi dollar even more stable at 65.50 in the middle of the range of 65 to 66.40. Okay, these are the main currency pairs to watch. Relatively, we're expecting busier days than yesterday, but perhaps a bit busier than we had. Busier than yesterday, but not extremely busy. Next week, it's much busier. I see, before we do the preview for next week, I see a few questions. Stock exchanges in the United States are giving 30% discount to central banks to buy stocks. What a scam. Yeah. You mean the fees, or? Anyway, I'm not following the US stock market that closely. Stocks, well, generally are quite stable in range. And S&P, if the ECB really does a lot of QE and cutting the negative deposit rate, it should be the first reaction should be first euro negative and stock positive, stocks here in the Eurozone, because the ECB is basically printing more money. So that's good for stocks and bad for the euro. Eventually, if the economies do improve and stocks go up, it will attract money back into the Eurozone, but that's not on the near-term scope, okay? Now, let's talk about, let's do a preview for the first week of December, a huge week in markets, the week of beginning Monday, November 30th, and ending on December 4th. Okay, let's talk about the events one by one, the key events, not all the events. It's very busy. So on Monday, we have German GDP, German CPI, consumer price index of the most important country, the one most sensitive to higher inflation. This feeds into the all Eurozone CPI figures. We have various German states releasing the figures during the day, with the final figure at 1 GMT. Last time, we have two figures here, the national one and the HICP. I would look at the HICP year over year as the most important one. It stood on 0.2%, and now it's expected to rise to 0.3. Okay, we have also pending home sales in the United States, and that's more or less it for Monday. Tuesday morning, early morning, is a huge day for Australia. We have lots of figures from China. The most important one from China is the Caixin manufacturing PMI. Okay, that's an indicator of Chinese manufacturing, and for Australia, it means imports. What China imports from Australia. So that's really, really important. It stabilized last month, 48.3. Let's see if it continues rising. 50 points separate contraction and expansion. And this is an independent figure, more than the government figures, more than the manufacturing PMI from the government. There you see the NBS. So that's, of course, higher. Makes sense. The government has more rosy glasses than an independent institution. And the same day, same night, Tuesday, very early morning here, we have the rate decision in Australia. No changes expected, but any changes to the statement, perhaps something regarding capital expenditure, perhaps something regarding the employment. These are going in separate directions. Be very, very interesting. Remember, it's the last decision until February. They have a break in January. I believe they will want to keep the pressure on the Australian dollar. They like the current levels, but they don't want it to rise. So they'll be relatively happy, content, maybe not happy, but they won't be all rosy. Okay, so that's a really important night for the Aussie on Tuesday morning. Then we have some figures from Germany, the unemployment change, sensitive politically, and then final manufacturing PMIs for Germany, France, Italy, and also Spain and the Eurozone. Okay, in the UK, it's also manufacturing PMI has an impact. For those of you trading the Canadian dollar, we have GDP on Tuesday. Last time we had it's a monthly figure for September, so it's last month of Q3. So we'll also have Not only we'll have also not only monthly but also quarterly. We have Canada is in recession, but a shallow one. Let's see how deep it is or not, or if it's emerging from that mini recession. Okay, that's important event for the loonie. And Tuesday we also have a first hint for the non-farm payrolls on Friday. So we have the ISM manufacturing PMI in the United States. Last time it stood on 50.1%, continuing its fall, showing weakness. 50 points separate growth and contraction, and US manufacturing, according to ISM, is on the verge of contraction. It's a small sector, but still carries importance because in the manufacturing sector, they actually manufacture stuff and not only sell services, even though the services sector is much bigger. Okay, things warm up on Wednesday. We have more from Australia, a speech by Glenn Stevens, and we have GDP from Australia. Quarterly figure, first and final, not like in the United States or in the UK. So also another important night for the Aussie. If the RBA on Tuesday says nothing special, then the GDP figures will have higher importance. Okay, if the RBA is very bearish or very bullish, these figures will be of less importance. Okay. Anyway, year over year we had 2% growth in Q2. Let's see if we have expectations already for Q3. No, not yet. Okay. We'll of course cover the events day by day. On Wednesday, we also have the CPIs from the Eurozone, 0.1% final figure for October. This time we have the preliminary, the early figure for November, and 1.1 in the core inflation. Let's see if these move to a different direction. I think it won't matter too much for the ECB, but it'll still move euro dollar. Okay. Then we have the ADP employment change, right? So it's around 200,000. Also a hint, it's only private sector, not public sector. Not always fully correlated with the actual NFP from the government, from the BLS, but still worth watching and still always moves markets. A rate decision in Canada Wednesday at 3 GMT. No changes expected, but let's see how the Bank of Canada sees the economy after the GDP figures, ahead of the employment figures in Canada on Friday, and with the new government there, with falling oil prices, lots to hear from them. They were relatively optimistic, Stefan Plows. Let's see if he continues this way. And then we have a bigger event. Janet Yellen speaks at 4 GMT on Wednesday. It's the first out of 2 speeches. I think it's very important. So it's a testimony. I'll have more details, of course, about that on Wednesday, but it'll probably be her last public appearance before, next week, before the bigger, the all-important Fed decision on December 16th, okay? So she'll have the opportunity to cement a rate hike, okay? To tell us that that's coming for sure, okay? So that's an important event, of course, as well. Thursday, we have a few more figures from Australia, another in the Eurozone, more PMIs from the services sector, also in the UK, but no, not in the UK. Anyway, of course, the most important event is the ECB decision. I talked about it more in detail before, but let's talk about this once again. ECB created huge expectations in October. Their tendency is to beat those expectations, perhaps keep them a bit low towards the actual event and then beat them. ECB wants a lower exchange rate to help the economies. 2 things are watched: the negative deposit rate, and I think there they'll really beat expectations. Expectations stand on a fall from 0.20 to 0.30. I think it'll go to 50 basis points negative. Perhaps a 2-tiered system, perhaps not. And expanding QE, extending and expanding. So from expectations stand on from 60 billion to 75 billion. I think that's more or less realistic. Anyway, I believe that Mario Draghi wants and can hit the euro hard. a weaken the euro, supporting the Eurozone economies. Huge event on Thursday. The rate decision is at 12:45 GMT, and the press conference begins at 1:30 GMT. Okay, we'll talk about, of course, in every morning show about all these events. But that's not it for Thursday, okay? Thursday, December 3rd is a huge day. I might be using too many superlatives, but it's really it's an important week. We have Janet Yellen testifying once again. I believe it'll be at 3 GMT, perhaps 4. We'll have more details next week. This is one day before the non-farm payrolls. The Federal Reserve she'll probably have the details in front of her eyes. Because it's the second testimony, I believe that Yellen will not say anything new. It's mostly questions and answers. They're in Congress. Many of the questions are not that intelligent, pardon US politicians. So she'll be deflecting them. However, if we hear her saying something about employment, that could give us some kind of a hint. She'll be very careful and cautious not to do that, but it certainly is possible. Okay, so watch out for that. Less about monetary policy for December. She might do that already on Wednesday, but on Thursday, maybe she'll give us a hint about the NFP. Another hint for the NFP coming on Thursday as well, from the ISM non-manufacturing PMI. This was quite upbeat last month, 59.1. The services sector is doing great according to ISM. We also have the final figure from market. ISM is more important. Apart from Yellen, we also have Stanley Fischer. He's a relative hawk, okay? But anyway, Thursday is Yellen and Draghi in the scene. Friday, as always, the first Friday of the month, the most important event and probably dominating the scene is US non-farm payrolls. If the Fed is indeed data dependent and still hasn't made the decision, this will serve as a hint. We don't have the numbers. Last time it was a blockbuster report, 271,000 jobs gained. I think I still have this slide here. I can show you all the figures. Yeah, 271,000 jobs gained. More importantly, perhaps, or as important, wages finally broke above this resistance line of 2.3 year over year, rose 2.5 year over year. Excellent news. Finally, not only are Americans working more, they're also getting better salaries. Okay, so breaking out of range. I don't think it'll be as good this time. We don't have the official expectations. I believe it'll be only around 200,000, maybe a bit less. Unemployment rate could stay at the same level of 5%, which is very low, but also the participation rate is low. I would watch, as always, two things: headline figure in the non-farm payrolls and average hourly earnings, this figure year over year. You see this break out of range? So it's the highest since 2009. Okay, and in 2009 it was a year over year figure. So anyway, this is the most important thing to watch, because inflation and wages turns into real inflation. The Fed has two mandates: inflation and unemployment. Okay, so these are the two figures to watch within the important event of the non-farm payrolls. And also for those of you trading the loonie, we have the jobs report in Canada. Last time it was very positive, 44,000 jobs gained, and unemployment rate there is 7%. Remember, it's higher than the United States, but the participation rate in Canada is also higher, so it's a bit skewed. Okay, so yeah, that's a long preview because it's a really busy week next week. So it'll be very, very exciting, surely more exciting than the past 24 hours because of the Thanksgiving event. Okay, we're almost running out of time, but I see we have a few questions here. With the Paris attacks, the tourist industry will suffer. Airlines will see lesser seats filled up. Feel that euro will be under pressure. Actually, was studying this topic of the impact of terror. It's usually a fade. It's usually people, travel less, go out less, and shop less. but it's just postponed. So if they don't buy today and on Black Friday, they'll buy it on Saturday, especially food and travel. I mean, it has a very big short-term impact. So if we had Brussels in a lockdown, of course, paralyze the city, but assuming and hopefully we don't have more of these attacks, I mean, one coming after the other, and we don't have borders closing down in Europe, which is the real critical impact, the real price for the terrorists, I believe that it'll only be a fade. Fabian says, unfortunately, we'll not be able to follow next week. I'll miss your great analysis. I wish you all guys a good weekend, a great next week. Well, sorry to hear that, Fabian. I really loved all your questions in the past few weeks, but I hope you'll be back next week. And yeah, and thanks for the kind words in general. Okay, so we talked a lot. It's almost a full hour now. Anyway, you'll be able to see the full recording of the show, the wrap-up, which was short, and the preview, which was very long, on fx3.com. So thank you very much, everybody. Have a good and successful trading day today, a great weekend, and we'll be here on Monday to keep you up to speed with a very, very busy week. Okay, so that's it for today. Thank you, everybody, and goodbye.